Now, really quickly, I want to talk about the mechanics of IRS casework. This is the actual, the licensed work of dealing with the IRS on behalf of your client. The first phase is what I call the investigation of liability. This is when you research the accounts with the IRS. This is when you're looking at transcripts. You're looking at what the IRS has proposed for an assessment on an SFR, or you're looking at a CP 2000, the mail audit, and you're looking at all the factors, all the moving parts from the government's perspective of what they're saying the liability is, and you're breaking that down. You're verifying returns, and you're figuring out what's missing, what needs to be done to satisfy the government's side. Then you're going to look at the client side. This is the financial analysis. The financial analysis is very important because it determines largely what programs the IRS offers that your client can qualify for. So from the financial analysis and the investigation of liability, you've got these two sides. You've got your client's side and you've got the IRS's side, and you're going to put them together and determine the best resolution option for your client, and then you're going to negotiate that resolution with the IRS. A lot of times you're going to end up in appeals for one reason or another. I'd say 60 or 70% of my installment agreements are actually granted through appeals rather than directly with revenue officers. And then if you do an installment agreement instead of getting an offer in compromise or non-collectible status, something like that, you'll usually apply for a penalty abatement on behalf of your client in order to try to get some of the penalties removed. After you have worked through the mechanics of the case, then you can monitor on an ongoing basis the taxpayer's IRS accounts. So these here are some of the basic steps in the investigation of liability. You've got to look over transcripts and returns. You've got to look at everything that's laid out in terms of TPI, tax, penalties, interest. You have to identify when the statute collection expiration date's going to roll around. You have to analyze recent notices. These are all the things that you do to determine the IRS's side of the story. On the financial analysis, the best way to look at the financial analysis is to think of it like a mortgage application. These are the forms 433 A, B, and F. And what we're looking at are three big things, just like they do on a mortgage. What are the assets and liabilities, and the income and expenses. So this is what goes into the financial analysis. From those two things, like I said, we're going to pick a resolution pathway. So if there's assets that we can tap for equity, then there's some things that we've got to do to satisfy the IRS that we attempted to tap into that equity. If there's disposable income that can feed an installment agreement, then we're going to look at maximizing the allowable expenses and minimizing income for our client legally so that we can get the smallest possible installment agreement payment. We may be looking at an offer in compromise or currently not collectible status if the taxpayer is eligible. Working with appeals. One of the nice things about appeals is that settlement officers have more time and service and are generally more experienced and have more extensive authority than most revenue officers. So a lot of times we're going to enter the appeals process by appealing a final notice of intent to levy, a letter 1058, through the CDP, Collection Due Process Appeal Program. And then sometimes we're going to enter appeals and resolve the case through a collection appeal, levy appeal. So there's various ways to enter appeals. There's also an installment agreement denials, offer and compromise rejections, trust fund recovery penalty issues. There's other various ways to enter appeals, but these are the biggest ones: the CDP and the levy, the CAPS, Collection Appeals Program, dealing with an actual levy that was issued. After an installment agreement, like I said, we're going to look at doing a penalty abatement. We have to determine whether or not the taxpayer situation fits into the IRS reasonable cause criteria, and whether there was a legitimate reason for the for the taxes not being paid. When dealing with 941 cases, there's really fine lines regarding what the IRS will accept as undue economic hardship, and doing due diligence on behalf of the business owner. One of the big kind of gotchas with 941 tax penalties is that the IRS has the stance that if you can't afford the taxes on an employee, then you shouldn't have the employee, and that part of being a business owner is analyzing that and making hiring and layoff decisions based on your ability to afford the payroll taxes, and that you need to take that into account. So that becomes a huge part of trying to get penalty abatements on 941 taxes. And then account monitoring. This is something I usually sell as an add-on service. Occasionally pulling updated transcripts to check for, that they're making, basically to make sure they're being good little taxpayers, as I like to say. So this is an additional revenue opportunity. You can advise them on notices. You can give them tax planning advice as part of this. You can make sure that they're making their installment agreement payments, or they're offering compromise payments. Make sure they're making their federal tax deposits and all that good stuff. But this is additional back-end revenue opportunity. I usually charge $1,000 to $1,500 a year for an account monitoring service. And like I said earlier, the real beauty of tax resolution is it's a lead generator for all your other services. So your tax resolution clients, they're in trouble because they don't keep up with these things. They need tax prep help. They need a payroll service. They need bookkeeping. Most tax resolution clients, their books are either non-existent or a mess. So they're going to need help with all these different services. So this maximizes the lifetime customer value.